These talks are brought to you by Claritax Books and are proudly sponsored by 6 Forward Capital Allowances.
Welcome back to our series of talks on capital allowances. This week's video will be the last on plant and machinery allowances, and we're looking at the topic of contributions to capital expenditure. If someone contributes to the costs of an asset being acquired by a second person, two potential issues arise. Can the contributor claim capital allowances for the expenditure incurred? And does the recipient have to reduce his capital allowances claim accordingly? The rules apply, subject to some variations, to most types of capital allowance, but our focus today will be on plant and machinery allowances. A person making the contribution can claim allowances where all of these conditions are met. The person contributes a capital sum to expenditure on the provision of an asset. The expenditure would otherwise have been regarded as wholly incurred by the recipient. Without the contribution, the recipient, if not a public body, would have been entitled to allowances or could have allocated the costs to a plant and machinery pool. The two parties are not connected. The payment is made for the purposes of a trade or other relevant activity carried on or to be carried on by the contributor. So, if I contribute £1,000 to the cost of a computer that a friend is buying, I may be able to claim allowances, but only if the contribution is for the purposes of my own business. Now let's turn to the position of the recipient. The general rule is that the recipient of a contribution is not treated as having incurred qualifying expenditure to the extent that that expenditure is met by a public body or by any other person. It does not matter whether the contribution is capital or revenue in nature. Even if the recipient repays the grant, partly or in full, HMRC take the line that he is still barred from claiming allowances. A repayable loan, however, is not a contribution. There are some important exceptions to the rule. First, a person's qualifying expenditure is not reduced by the amount of any insurance or compensation money if the money is received in respect of an asset that has been destroyed, demolished, or put out of use. Insurance proceeds may, instead, have to be brought into account separately as disposal receipts. Secondly, the recipient may be able to ignore the contribution and claim unrestricted capital allowances if the person making the payment is unable to claim any form of tax relief, whether by way of capital allowances or otherwise. However, this will not apply if the contributor is a public body as defined, so a contribution from a public body will almost invariably prevent the recipient from claiming allowances. These rules may need to be considered where a landlord contributes to a tenant's fitting out costs. The legal agreement may specify that the landlord is contributing only to assets that qualify for capital allowances as fixtures. Or the agreement may be silent on the detail, in which case the contribution will need to be apportioned between qualifying and non-qualifying expenditure. In these circumstances, the separate tax rules relating to reverse premiums may need to be considered. To the extent that the contribution reduces the tenant's qualifying expenditure for capital allowances purposes, the payment will not be charged as a reverse premium. This produces a number of different permutations of possible tax outcomes, and the best result in any case may depend on the respective tax positions of both landlord and tenant, so some careful planning may be needed here. So that's it for plant and machinery allowances, but we're not quite done. We're going to end this series of talks with 2 more videos, one giving an overview of business premises renovation allowances, and the last taking a look at research and development allowances. Thank you for watching. I'm Ray Chidell, author of Capital Allowances and of the A to Z of Plant and Machinery from Claritax Books. This talk was sponsored by 6 Forward, an independent property tax consultancy working with accountants to enhance capital allowances for their clients.